Hello, good morning, and welcome to the Mining Show on Core Finance, sponsored by Blythe Way. Now, as you'll know, it's early in the reporting season for miners. Miners typically report quarterly, and one of the first companies out of the traps as far as its reporting season, as far as this reporting season is concerned, is Serabi Gold. And joining me now is the Chief Executive, Mike Hodgson. Mike, very good morning to you. Thank you very much indeed for joining us. So tell us, second quarter results, what did they show?
Pretty decent. We actually had a little over sort of 8,100 ounces, which was a little bit down on our Q1 numbers. Q1 we did around 10,000 ounces. Our guidance for the year is 40,000 ounces. So we're on track. We slipped a little bit in Q2. That was down, as I wrote in my press release last week, of an operational problem at Serabi, which I'm pleased to say is behind us. We had an excellent June, and in fact Q3 started, we're absolutely flying in Q3, and July was our best month year to date. So we're happy that we'll probably be able to catch up that small shortfall in Q3 and Q4, and we're on guidance. Good grades, 7-8 grams per ton. Plant absolutely flying, so can't really ask for any more.
Excellent. So what was that little operational problem? Can you tell us the nature of it?
Yeah, I mean, at Palito, we have two ore bodies feeding the Palito operation, Palito and Serabi. At Serabi, Palito is a classic narrow vein mining. We've got about 25 veins in our resource of around 500,000 ounces. And the vein mining there is classic, almost like classic Cornish tin mining. It's narrow vein, selective mining using jacklegs. It's all about quality. Grades about 9 grams per ton. At Serabi, the ore body is wider. It's a single vein structure. The ground conditions are a little weaker. It lends itself, but those wider widths and softer ground lend themselves to a more mechanical method, and we use long hole open stoping there. But because that requires a machine to go into the open stope to actually muck the ore, it's a remote control machine. Now, we've only started stoping at Serabi this year, and in fact, or late last year, and we only had one remote control scoop. We do exist in a relatively remote part of Brazil, and we have two of these machines now, but at the time we only had the one, where if that machine goes down for 4 or 5 weeks, it takes 4 or 5 weeks to get it up and running, and you're somewhat sort of stuck. People would say, well, you should have contingency. Well, we're trying to, and we did, but it took it caught us out just for that month. So we had to live off development ore for that period, and that was same volume but lower grade, and that's why we had less ounces, and it is purely that. By June it was solved. July it's solved, so we're now, hopefully that problem is behind us.
And you now have two machines. So
we have two machines, so we've got cover. We don't actually need two, but we have one and one standby, and that's the nature of the beast. I mean, we actually have we try and have contingency in every area. Although the whole area infrastructurally is improving, we're on grid power, etc. But at the end of the day, we are a long way from Sao Paulo. We're the same distance as we are today from Turkey. We're in the same country, but it's a long, long way away. And at the end of the day, all you can have is a reasonable amount of contingency. You can't kill yourself with contingency, obviously, but enough to cover the big items.
What actually went wrong with the machine?
It's the actual remote control. These things are actually run by a guy standing a long way away, and it's radio controlled essentially. And that unit broke down. And yes, it's all these
with a Game Boy.
These guys, the older guys, don't know how to do this thing, but these kids with working on the Game Boys or the Xboxes or whatever, they're experts.
They're ninjas.
So, yes.
So what, he was telling it to go left and it went right, sort of thing, or it
just wasn't going.
Battery. So, all right. So that's the operational stuff. What about the financial stuff?
Well, we're in decent shape. We've got about $7 million in the bank, so cash is growing gently. We're always battling. I mean, we have a good margin on our ounces, say in dollar terms, but of course the one thing we actually have to battle, 85 to stroke 90% of our costs are in reais. So the gold price in reais is what's important to us, because that's our costs are in reais, so therefore gold price in reais is what's important. We started 2016 with a real rate of around 4 reais to a dollar. By the end of 2016 it was 3 reais to a dollar, so essentially we suffered a 25%, a fair old reduction in the value of the real, and therefore that just eats straight into our margin. We saw a little bit of recovery this year, and we're hovering around 3.12 today. It did actually pop up to about 3.3 in April, May, which was helpful, but it slipped back a little bit. So that's something obviously we have to cope with. Every Brazilian producer has the same problem. You know, I sort of have this conversation with many of my colleagues operating in Brazil. But that said, we're mining, as I said, 8 grams, 9 grams, that region. So we've got a decent grade that's very helpful. So even at these prices, we have a good margin. For example, today we're probably running just under $1,000 an ounce all in sustaining. So we're sort of got a $200 margin. So cash is being built up. However, we did, over the last 18 months, we took out a debt with Sprott. Took out about an $8 million debt facility. We actually paid that off down to $1 million, but we did take the opportunity on good terms to actually increase that a little bit again. So we've actually got a little bit more debt facility in the company at the moment. So $7-8 million cash, generating cash. So we're sort of quite comfortable now.
And is the Brazilian currency, the real, is that, if you were to look at a well-known commodity currency like the Canadian dollar or the Australian dollar or particularly the rand, you tend to get strong gold price and strong rand, or weak gold price and weak rand. So, so if you like, they're naturally hedged. Is that the same with the real?
It certainly was. There was almost that natural hedge there. When the gold price went up, the real tended to strengthen, or vice versa. And we kind of had this relationship for a good while, where literally the gold price was stuck at about 4,300 reais an ounce. So whatever the gold price did, the real would correspond to keep that kind of equilibrium going. We did actually see in the second half of 2016 that relationship begin to fail, and in fact the gold price fell and the real strengthened, which was kind of
that's a double whammy.
The bad scenario, and we actually ended up with a gold price in reais of about 3,700. And just to illustrate what that did to a company like us, our costs are flat, so but our revenue reduced by 1.5 million reais a month, or $500,000 a month. Pure and simple. That was so we had to tolerate that, but we still did, and we can still make money. But obviously, I mean, I can say today, if we were back with the 4 real to $1, we'd be writing checks, big time. It'd be, but I say 3.2. That's as long as we don't go through 3 again, I think that's certainly that's something we can cope and live with.
So it gets painful below 3 for you.
Yes, but it will do for virtually everybody.
Yes.
Where there's a lot worse off than us. I mean,
is it? Gold hedging is not in favour amongst investors.
Yeah.
But they sometimes take a slightly different view if a currency gives you trouble over currency hedging.
Yes.
Is that something you could consider?
We have looked at it, and when we certainly thought about the amount of debt. We haven't got a lot of debt, to be honest. I mean, I would certainly be in favour of looking at that, certainly to cover the debt part, perhaps. But I take your point. I think a lot of people are investing in junior gold stocks for the exposure to the gold price, and if you kind of take that away, that's probably that's the whole reason.
That takes away the raison d'etre for the investors.
Yes. So,
but currency is really, that's more about hedging your cost, isn't it? Rather.
Yes, we have looked at. To be perfectly honest, every time we've looked at it, there's nearly always been an adjustment naturally, and we sort of go, okay, it's kind of solved itself, and we go back with the rate. We did seriously look at it last year, and then we kind of backed off. And by the time it wouldn't be a fast. We've looked at it. It's not a very fast thing to put into place. And by the time we've actually finally got there, the
exchange rate's moved in all
way. No, let's not do it. And it's very. The secret to all of this is more ounces. More ounces. Spread our costs over more ounces, and that's obviously what we're trying. That's what we're trying to do.
Okay. So, as I interpret it, everything is going nice and smoothly as far as you're concerned so far this year, and your guidance is unchanged for the full year. But tell me, what does Serabi look like in a couple of years' time, or 2, 3, pick a number? As far as you can see ahead, from where it is now, what would you like it to look like in the future?
Well, we've had some trips recently from analysts and various groups. We're very excited about our organic
good stories, because they usually are.
Well, there's nothing really I can talk about yet, but certainly. But people ask me all the time, what next? Okay, you're doing 40,000 ounces, all very good, very nice. It's modest, it's generating money, but you've got a 55% shareholder, which they've been super supportive right the way through. But we are a fairly illiquid junior stock with modest cash flow, doing okay, but our share price is very flat, and so really it's how do we actually address the problems of the illiquidity, the market interest, and get our ounces up. It's so one thing, of course, is to fund exploration from cash flow. That's a slow process. We don't generate huge amounts of cash flow, and of course we always want to keep a fair amount in reserve because we never quite know what this real is going to do and how much we can do. I mean, the potential at Palito and Sao Chico is huge. I personally think we have a 2 million ounce target there. We've actually got to basically do the simple maths. Palito is a 500,000 ounce resource. We're having a new 43-101 done as I speak. Hopefully that'll be out early Q4 this year. And that's we do our 43-101s are rather out of date, as you may recall. Palito was put back into production as a brownfield site in 2013-14, and Sao Chico is a satellite asset which we picked up along the way. And we've inherited kind of 2 old 43-101s. We're doing a new one which will obviously help enormously. Hopefully, say end of Q3, early Q4. But Palito itself is a 1 kilometer strike length. Drilled out section, but the traces of the actual zone are now 4 kilometers long. So just simply doing the maths, I think we're looking at a 2 million ounce property which needs drilling out.
Okay, so do you double production, or do you quadruple the life of the mine? Or?
We would certainly. My aim is to raise the money or looking at funding options to get our production, at least do a double production rate and get us up into the 80,000 ounce range. Certainly in the next couple of years. I mean, the plant expansion is very easy, both at Palito and Sao Chico. But Sao Chico is the other ore body, similarly completely open along strike. To the east and west and at depth. And so we have the situation today, we truck ore from Sao Chico to Palito. We don't know whether we should put some kind of plant capacity or facility down at Sao Chico to truck a concentrate rather than ROM. But at Palito, again, everything lends itself towards an expansion by putting in another another access, sort of have a series of smaller sort of, I don't want to call them mini mines, but sort of more attack points, let's say, along strike to actually get our production up to 80,000 ounces. Because, as I said, the secret is more ounces, more ounces, same costs, more ounces. That's and then you don't worry about exchange rates anymore. You have your margin is protected.
Excellent. All right, Mike. Well, we wish you the very best of luck. We will look forward to that 80,000 very much indeed, and come back for the third quarter as well and tell us how it's all going.
Pleasure. Thank you very much. I will do.
Here, not at all. Ladies and gentlemen, I'm afraid that's all we've got time for. That was Mike Hodgson, the Chief Executive Officer of Serabi Gold. I always leave you a little statistic about our guests, and I suppose for this one, I'd have to say, the share price, if you looked at the beginning of 2016, was about tuppence halfpenny, and now it's close to fourpence halfpenny. So, as they say in America, you do the math, and we'll look forward to seeing you next week. And in the meantime, I'm Charlie Gibson signing off. You have a capital day.